Assalamualaikum and good day to Professor Dr. Amirul Afif. We are from BA 2793B and today we will be presenting our case study on Domestic Feedlot Corporation, Dfcorp and its quest for capital. Before we begin, let me introduce our group members. My name is Nur Izzaziatira and together with me are Adriana Badlisha, Nur Ain Zulaika, Shahidatul Adriana Natasha, Muhammad Rohaizat and lastly Nurul Aina Afika. Without further delay, let's begin with the introduction of our presentation. In recent decades, the Islamic finance industry has experienced rapid growth due to the increasing demand for Sharia-compliant financial products. Islamic finance prohibits elements such as riba, gharar, and maisir. Instead, it promotes ethical financial practice through fairness, transparency, risk-sharing, and asset-backed transactions that contribute to the real economy. One of the key instruments in the Islamic capital market is sukuk. Although sukuk is often compared to a conventional bond, it is different because investors do not receive interest payment. Instead, they own a share in the underlying asset or project and earn returns from the profit generated by those assets, making sukuk fully Sharia compliant. Malaysia is recognized as one of the global leaders in the sukuk market with various sukuk structures such as ijarah, murabahah, musyarakah, and istisna. All of these sukuk structures are being used to finance projects across sectors including construction, energy, transportation, manufacturing, and agriculture. Therefore, this case study aims to recommend the most suitable sukuk structure to help Dfcorp obtain the financing required for its business operations and future expansion while complying with Islamic finance principles. Next, I will explain about the company background. Domestic Feedlot Corporations, also known as National Feedlot Corporations or Dfcorp, was established in 2006 under the National Feedlot Centre project managed by Datuk Seri Dr. Muhammad Saleh Ismail as Executive Chairman. This project was a Malaysian government initiative aimed at expanding the local beef industry and reduce the country's dependence on imported beef. Dfcorp operates an integrated livestock business that manages the entire beef production process from cattle farming to supplying halal certified beef products to the Malaysian market. In its early stage, the company received government financial assistance to develop feedlot facilities and increase domestic beef productions. However, the company later faced operational and financial challenges that prevented it from achieving the production targets outlined in its business plan. As a result, government support was suspended, placing additional financial pressure on the company. Currently, Dfcorp requires approximately 1.2 billion ringgit to continue its operation and expand its business. However, it has already reached its borrowing limit with financial institutions and is unwilling to issue new shares because doing so would reduce the ownership of existing shareholders. Therefore, the company needs an alternative financing method that can provide sufficient capital while supporting its long-term strategic objective.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Razak Raslan and my student ID is 2024441284. Today I will present 3.0, the ratio analysis for the Domestic Feedlot Corporation from 2011-2013. We will start with 3.1, leverage ratio, which shows the company, financial risk and long-term survival. First is the solvency ratio, which measures if company cash flow can cover its long-term debt. From 2011 to 2012, Dfcorp looked very healthy as the ratio increased. This growth was driven by 2,050 million ringgit government fund to run the Domestic Feedlot Centre or DFC. However, in 2013, the ratio dropped due to internal operational and financial crisis. Because of this management, Dfcorp failed to meet the government requirement and completely lost its financial support. Next is the gearing ratio, which looks at how much the business relies on debt versus its own equity. From 2011 to 2012, the Dfcorp gearing ratio shot up significantly. This means they took on heavy debt and risk to build a major infrastructure like the Feedlot Centre in Labu Negeri Sembilan. By 2013, the ratio dropped. While a lower ratio normally looked like a good thing, here it was an illusion. It didn't drop because they paid off the debt. It dropped simply because of the government cut off their funding, leaving them with scarce capital and no funds to rely on. Now let's move on to 3.2 profitability ratio, which show how efficiently the company made money and managed its costs. First is the profit margin ratio, which measures the revenue left over after paying all business expenses. In 2012, things looked very promising as the margin improved significantly. Thanks to the 2,050 million ringgit injection, they successfully expanded operation and saw a positive return on their sales. However, in 2013, the profit margin completely crashed. This collapse was triggered by a major operational failure highlighted in 2012 Auditor General report. The Labu Center was highly inefficient and missed its target completely, causing expenses to quickly outpace revenues and creating a deep financial crisis. Finally, we have the return on total asset, or ROA, which measures how well a company uses its asset to generate profits. So, following the same pattern, the ROA rose dramatically in 2012. Backed by government fund, they successfully expanded their agricultural operation and effectively turned those assets into income. By 2013, however, the ROA fell into negative. This means their assets were no longer tools for making money. Instead, they were actually costing the company money just to maintain. Left with underperforming center in Labu and no more government help, the company financial foundation was completely destroyed.
My name is Nurulaina Afika and I will explain what sukuk is suitable for our topic. First of all, let me explain what is sukuk. Sukuk is the market of Sharia compliant, independent and corporate Islamic structured financial instruments that has grown dramatically in recent years and is now worth billions of dollars. However, risk management and competition encourage sukuk structures to advance and provide Sharia compliant substitutes for traditional derivatives. Deep sukuk frameworks may be required for financial markets in emerging economies to reach their full potential. Sukuk that is suitable in our topic based on the ratio we have been calculated is sukuk al-salam, which is Islamic forward sale contract. Sukuk al-salam permits investors to pay in advance for commodities that will be supplied at a later time. It enables the issuer to obtain immediate funds for operations or production. Investors receive a profit margin in addition to their money back. Then, the delivered items are usually sold on the spot market by an agent rather than being freely tradable secondary market investments. This structure is appropriate for short-term funding. So how sukuk al-salam works for Dfcorp? So, the institutional investors such as Bank Barokah pay Dfcorp an immediate upfront capital payment. Then, Dfcorp commits to deliver a specific standardized amount of commodities with exact quantity and quality specifications of beef or cattle at a predetermined future date. Then, the purchase price is fixed at a discount to the anticipated future market price to provide investors with a viable return. Lastly, the resulting price difference represents the profit given to investors at maturity growth of sukuk market.
So, why sukuk al-salam? Dfcorp core business involves cattle and beef production, making sukuk al-salam the most suitable financing instrument. Under this structure, investors make payment upfront while the commodity are delivered at a future date. This allows Dfcorp to obtain funding before production is complete, which is highly suitable for agricultural and livestock-based business. Dfcorp urgently required 1.2 million ringgit to continue its operation. Since the company faced difficulty obtaining conventional financing and does not want to issue new shares, sukuk al-salam provide an effective alternative. The company received immediate capital from investors without paying interest, while existing shareholders maintain full ownership and control of the company. Due to previous management issue, Dfcorp creditworthiness has weakened. However, sukuk al-salam focus more on the underlying community rather than company credit history. Investors assess Dfcorp ability to produce and deliver cattle and beef in the future, making the structure suitable even in the company's current financial condition. Another advantage of Suku Asalam is its flexible repayment structure. Unlike conventional bonds that require regular interest payment, Dfcorp only need to deliver the agreed commodity at a future date. This helps preserve cash flow and allow the company to focus on its production activity. To further strengthen the structure, Dfcorp can enter into a parallel salam arrangement with hypermarket. Through this arrangement, hypermarket agree to purchase future beef production. This reduces delivery risk, guarantee market demand, and provide greater confidence to investors. Overall, Suku Asalam is the most suitable financing instrument for Dfcorp. It provides immediate funding, comply with Sharia principle, avoid ownership dilution, and align well with the company production cycle. Therefore, it should be recommended as the preferred financing solution for the DF Corporation.
Now, I will proceed the presentation with the business strategies proposed for Dfcorp to improve its performance and ensure long-term sustainability. The first strategy is expanding satellite farm collaboration. According to the case study, Dfcorp was unable to establish the number of satellite farms initially planned under the National Feedlot Program. As a result, cattle supply and production capacity remain below target. To address this issue, Dfcorp should expand its satellite farm network through a contract farming model involving local cattle breeders and small-scale farmers. Under this system, Dfcorp provides cattle, feed, veterinary service and technical support while farmers raise the cattle according to company standards. This strategy enables Dfcorp to increase production without investing heavily in new large-scale facilities. The company should also establish a monitoring unit and use digital livestock tracking system to ensure efficient farm management. The second strategy is strengthening supply chain and livestock management. Dfcorp should secure long-term feed supply agreements to ensure stable pricing and continuous feed availability. In addition, the company should implement structured breeding programs, schedule vaccinations, and stronger veterinary supervision to improve cattle productivity and reduce disease risk. A database monitoring system can also be introduced to track feed intake, cattle weight, and health conditions in real time, allowing better decision making and improving operational efficiency. The last strategy is diversifying into value-added halal products. Since Dfcorp currently relies heavily on cattle production and beef supply, the company is exposed to risks such as supply shortage, price fluctuations, and limited revenue streams. And because of that, Dfcorp should invest in downstream activities such as meat processing, packaging, freezing, and ready-to-cook halal products. This will create additional revenue streams, improve profit margins, and reduce dependence on cattle sales alone. Furthermore, developing strong halal brands for local and international market can strengthen Dfcorp's competitiveness and support long-term growth.
In conclusion, Dfcorp has faced several financial and operational problems that affected its ability to operate effectively. Based on the ratio analysis, the decline in profitability was mainly caused by poor management and the loss of government assistance. Therefore, Dfcorp needs a suitable financing method to improve its financial condition. Based on our analysis, Suku Asalam is the most relevant choice because it meshes with Dfcorp business activities, especially in producing cattle and beef products. Through Suku Asalam, Dfcorp can receive funds immediately and repay through the delivery of goods at a later date. Besides financing, Dfcorp also needs to improve its business strategies by strengthening farm collaboration, improving supply chain management, and producing more halal value-add products. Overall, with proper planning, better management, and Sharia-compliant financing, Dfcorp can overcome its current challenges and strengthen its position in the halal agriculture sector. So, that's all from us. Thank you.